welcome to the Explainer. Today, we're going to unpack a puzzle that honestly, it baffles even the pros. So let's get right into it. You know that feeling, right? That pit in your stomach when the market just tanks, but then almost like magic, it bounces back, sometimes even stronger. So what is actually going on? And look, this isn't something that just started happening. It's a pattern we see over and over again. These scary, sharp drops followed by this relentless climb upwards. It's easy to think the whole game is rigged, right? But the real answer isn't some backroom conspiracy. It's actually baked right into the very mechanics of how our global economy works. Okay, so what are those mechanics? Well, it all comes down to two huge structural imbalances that are basically running the show behind the scenes. So picture this. You've got two sides of the global coin. On one side, you have these massive producer countries, almost like giant factories, that make way more stuff than their own people can possibly consume. That creates this huge surplus, a mountain of savings. And then on the other side, you've got the consumer countries, buying way more than they produce, which leads to a persistent and growing deficit. Now, this kind of imbalance, it doesn't just sit there. It creates some serious political headaches. I mean, think about it. When a flood of cheaper imported goods starts threatening jobs at home, you better believe politicians are going to feel the pressure to do something. And what they do sets off this chain reaction that they can't really control. And this is where we get to the heart of the matter. Because when they're staring down the barrel of rising unemployment, these politicians find themselves stuck in what you could call an inescapable loop. Okay, so check this out. The number one rule for any politician is pretty much don't let unemployment get too high. So what do? They have to stimulate demand, right? They start spending. A lot. And usually it's money they don't actually have. This creates these enormous government deficits and piles of public debt. And guess who has to deal with that? Yep, the central banks. They're basically forced to step in and provide the liquidity, print the money, to finance all that debt and keep the system from seizing up. And this is the key takeaway here. It's not like the central banks want to do this. I mean, whatever they might say publicly, their hands are tied. They have to inject this liquidity. They can't just jack up interest rates because doing that would risk a total collapse of the financial system. So it's not a choice. It's a structural necessity. They're locked in. All right, so we've got this loop of government spending and money creation. But how does that actually make the stock market go up? Well, as they say, you've got to follow the money. The best way to think about it is this. All that money being pumped into the system, it's like water pouring into a bathtub. And all the assets, stocks, real estate, you name it, they're like corks floating in that tub. As the water level rises, well, what else can the corks do? They have to float up with it. Exactly. I mean, all that liquidity has to find a home, right? It can't just sit there. So it floods into the markets, the S&P 500, real estate, gold, even things like Bitcoin. And all that new money chasing a limited number of assets, it just pushes prices up and up and up. And get this, there's a second massive driver pushing things up too. Remember that giant pile of savings from the producer countries we talked about? Well, where do you think they invest it? A huge chunk of it flows right back into U.S. financial assets. So you've got this double whammy, newly created money from central banks, plus a constant inelastic flow of foreign savings, all pouring into the same place. That's some serious upward pressure. Okay, so we've seen the big picture, but what does all of this actually mean for you, for your savings, your wealth, your future? It really comes down to this one crucial concept: monetary debasement. It's a fancy term, but all it really means is that the very system that's designed to create stability is also, by its very nature, destroying the purchasing power of your money over time. That dollar you tucked away in a savings account, it's guaranteed to buy you less next year than it does today. Why? Because the supply of those dollars is constantly going up. And that is the fundamental reason why the market has this upward gravity. It's why, even with all the terrifying crashes and scary headlines, the long-term chart for most assets just keeps going up and to the right. It's not an accident. The system is literally engineered to produce this outcome. All that short-term volatility, that's just the price you pay to participate. It's the noise. The long-term upward trend, that's the signal. So this all leaves us with a pretty deep question to think about, doesn't it? If the money we use to measure value is constantly being devalued itself, how do we know what anything is truly worth? It's a real puzzle. We'll leave you with that thought. Thanks for joining us.